tonight, let's call them heavy metals because that's what they are. And because that was funny. Come on, I'm laughing on the inside right now. And because the action in both gold and silver has felt a little heavy lately, ever since they made their highs about a month ago. But while they're mostly going sideways since then, it's a big change from their phenomenal runs earlier in the year. That's why tonight we're going off the charts with our resident commodities expert, Carly Garner. She's that perfect technician who's the co-founder of DeCarly Trading and author of Higher Probability Commodity Trading. Last year, she nailed both the top in oil and the bottom, too. Who else did that? 3 weeks ago, she told us copper would continue to be weak, and so far she's been very right. So-called super cycle may not pan out. So where does she come down on heavy metals? When it comes to gold and silver, Garner's always told us that owning these commodities can be truly agonizing for buy and hold investors because they can deliver, while they can deliver some steady long-term gains, they also tend to make sudden, often irrational moves practically overnight after long periods of consolidation. On the other hand, active traders often get caught with their pants down because they like to chase momentum, but you tend to get the best opportunities, best buying opportunities, when the precious metals have no momentum whatsoever. Right now, Garner says both gold and silver are at an inflection point. Either the near-term floors of support hold, only heading to substantially higher prices in the not-too-distant future, or they fall through the floor and get hit with a 10% haircut in short order. Although Garner's betting on the former, she thinks the latter is a real possibility, which is why she wants you to proceed with caution. But before we get to the specifics of the precious metals, let's talk about the backdrop. Check out the monthly chart of the dollar index futures, which measures the greenback against a basket of foreign currencies. So far this year, we've had big rallies in gold and silver, and Garner thinks it's very important to note that this has happened without any help from the dollar. When the dollar comes down, then dollar-denominated assets go up in price, assets like gold and silver. But the dollar's been hovering at historically lofty levels, with the dollar index bouncing between 100 and 107 for the better part of 2 years, meaning the metals haven't been getting any kind of currency-related boost. And you can see that these are moving averages, by the way, but they show you the kind of a collective view of what's happening. Eventually, though, Garner expects the greenback will come back to earth, and the precious metals, along with every other dollar-denominated commodity, will get a boost. Now, when you look at the Williams percentage R oscillator, now what is that? Come on. That's an important momentum indicator created by a friend of the show, Larry Williams. It shows that the dollar index is hovering around overbought territory. That means it's higher end here, okay? It could be due for a pullback. Meanwhile, the relative strength index, the RSI, this is the Williams percentage. See, that's a high. The RSI is another momentum indicator. It's been sluggish. And according to Garner, that points to long-term weakness. So you have this peaking, that's the Williams percentage R, and this being sluggish, and that together adds up to being not a great situation. So Garner sees it, the U.S. dollar's topping out here. Now, that would be big. And it almost looks like the mirror image of the dollar's bottom during the financial crisis. So you can go all the way back to the financial crisis. You can see when that bottom. If that similar continues, she expects the dollar index to pull back to the 88 to 92 area over the course of months or years. Now, that would be a huge decline for a major currency. I mean, that would be amazing. And it would give metals pricing a major boost. Remember, decline in the currency, boost in gold, and boost in silver. That almost always happens. By the way, if you believe interest rates are eventually coming down, as I do, then that's another positive for gold and silver. Higher rates make people less likely to park their money in precious metals because you can put it in cash and instead get a 5% plus yield. These are all complex concepts, I know, but I'm trying to get you involved with what's really behind the scenes. So how about the charts for gold and silver themselves? Let's start with this monthly pivot graph of the action in silver futures. Garner points out that silver's rally last month ran out of steam at $32, okay, which was an important technical level. However, the failure to break through that ceiling doesn't necessarily mean silver has peaked. It just complicates things. Garner also notes that the monthly relative strength index never reached extreme overbought levels and still points higher. Okay, now this is RSI. No Williams percentage of this, would just spit out RSI. Don't forget all the geopolitical tensions that drove the precious metals rally earlier this year are still with us. That's why Garner believes that silver can only break out to the high 30s, although it might retest its previous breakout area near 2570 before that happens. Then again, she also sees a monthly pivot line at 2875. It's been a very strong floor of support for decades, meaning there might not be that much downside here. So 2875, this is the key level, the green line, and so she thinks that most you get is like a 10% price. I think that's it. When you zoom in on the daily chart of silver, you get a much more positive picture. Even as it's pulled back from highs over the last month, wow, okay, it can hold there. Garner points out that silver's created an expanding channel with a floor at 28.75, less than a dollar below where it's currently trading, and is sitting at 35.50. That's an odds game I like. Plus, when you look at this chart of the seasonal pattern of silver, the way it tends to trade over the course of the year, you can see that silver prices tend to make a significant low in late June or early July before rebounding. Pretty self-evident, right? How about the monthly chart of gold? In Garner's words, the April and May gold rallies were a bit extra, and now we're digesting these moves. She could see gold pulling back to 2,150, down nearly $200 from here. Before it finds its footing. On top of that, there's a divergence in the relative strength index. Once again, we go down here. I would suggest that when prices turn south, it can get real ugly. If you're bullish on gold, what Garner's saying is this is a long time to push it up. At the same time, she only believes it could be headed to 2,600 based on the monthly trend line. So you have permission to buy gold when it dips, and she does say it's going to dip. By the way, when you look at the action in gold from 2006 to 2011, when we went through the financial crisis and the aftermath of massive government stimulus, Garner points out that gold made a big move before the crisis and two more runs after the crisis, with the third being quite large, but producing exactly the kind of RSI, relative strength index, convergence we're seeing now. In her view, we're now in the third step of what she calls the COVID rally. Like with silver, gold's daily chart paints a much more optimistic picture. Let's see, we're at a level support. After trading sideways for a month, the RSI, relative strength index, is flatline, but the Williams percentage R oscillator has pulled back from overbought levels and is now pointed higher. All right, in other words, we're not overextended here, which is really a godsend versus the last chart. If gold futures can hold above trendline support near 2,300, Garner thinks we can sidestep any serious pain for potentially running into some turbulence near 2,380 and then 2,480. On the other hand, if light summer volume allows gold prices to decline to 2,150, she'd recommend buying aggressive. So I guess what we're saying here, to put it all together, is buy anything on weakness. It's not over yet for these, but don't get too excited and don't buy right now. Here's the bottom line. The charts delivered by Carly Garner suggests you might want to lock in some gains and even ride this gold and silver rally all year, but she sees enough potential upside to recommend keeping some of your precious metal bets on the table. You know what? I think that's actually the responsible approach right here, right now. Let's go to Mark in Iowa. Mark.
Hi, Jim. First of all, I'd like to thank you for taking on the work and responsibility of the investing club and doing such a great job at it.
I hope you're on Thursday's call at noon. I think it's going to be a good one. How can I help you now?
Well, gold has pulled back a little from its high in May of around $2,400 an ounce, and I've seen estimates that put it up around $3,000 an ounce by year end. This mining stock was purchased well before the highs in gold prices and the stock's 52-week high of about $19. They've met their first quarter numbers, have a PE of 20 times and an EPS of 82 cents. At today's stock price and what would be a good profit, would it be wise to hold this stock until the prices of gold goes higher, or is it time to ring the register on this gold and copper miner Barrick Gold?
Okay, my take is please don't give up on this one right now. As a matter of fact, I expected the drop, after listening to Carly Garner, who's my gold expert, maybe to the high 15s, but then I would buy it, not sell it. It is not the best, though. There have been others that have done far, far better. My addiction to it has not been requited. Agnico Eagle, which is up 20% for the year, is the better one, even up here. Wow, ouch. Ron in Florida. Ron.
Hey, Jim, how you doing?
I am doing well, Ron. Great. What's up?
I've been watching the stock ever since you had it on the show. And it's been a nice, slow and steady investment. It's got me diversified. It's got me out of AI. It's been going up nicely. And now it's had a nice pullback. And I'm wondering if it's in trouble or if it's time to buy a little more. The 3-month chart looks really interesting, and that is CRH.
Okay. When I saw CRH, yes, we had CRH on. This is a great industrial, but I'm going to be really candid.